Chapter 3: Central Banking. With the first and second layers of money established, governments began to involve themselves as an intermediary between these two layers. By mandating everyone to use government-specific bills, governments were able to grow their influence in financial affairs and restrict the freedom of free market currency denominations from forming. In the 17th century in Amsterdam, VOC, the world's first stock-issuing company, was created. The VOC, a Dutch East India trading company, commissioned ships and armies to facilitate international trades of spices from various regions of the world. As the company grew, initial investors wanted to sell their share of ownership and realize profits. This trade of stocks from one investor to another led to the creation of the world's first stock market. At the time, there were 1,000 different coins being used to settle trade. A common currency was desperately needed to facilitate the settlement of stock exchanges. In 1609, the formation of the Bank of Amsterdam led to the subsequent formation of its currency, the Dutch guilder. To consolidate all currencies under a single currency, a decree was made where everyone had to trade in their gold and silver coins for Dutch guilders. By banning ownership of the first layer of money, everyone was effectively forced to use the second layer of money. And since all payments were now facilitated by the Bank of Amsterdam, the government had full visibility in the flow of capital throughout society. The Bank of Amsterdam was now the world's first central bank. Another profound change to note with the Bank of Amsterdam's creation means that for the first time in history, gold and other precious metals weren't the only entities in the first layer of money. The Bank of Amsterdam made loans to the VOC during the company's expansion. These loans were considered as assets under the bank's balance sheets. With the Bank of Amsterdam having complete dominance in the economy, their shares of the VOC were considered to be on the same level as precious metals. In England, following the shift from a monarchy to a parliamentary form of government, the Bank of England was created to centralize banking in the country. The bank's role was to purchase government-issued bonds to increase funding for the war to expand the British Empire. The Bank of England utilized both silver and gold as the first layer of money. However, in 1717, Sir Isaac Newton came up with an official exchange rate between the two precious metals. The exchange rate made it profitable for arbitrageurs to export silver and import gold. Over time, silver was eventually phased out from the first layer of money in England. The British Empire's influence reverberated throughout the rest of the world, and the gold standard was eventually adopted worldwide. In England, not 2 but 3 layers of money were present. The first layer was gold. The second layer was the British pound. The third layer were banknotes used to redeem not gold, but the British pound. As more and more layers of money were formed, the properties of elasticity and fragility came into play. Since the quantity of the first layer of money, like gold, isn't easily expandable, elasticity is low and fragility is low. As you get to the lower layers of money, elasticity increases due to the compounding effects of fractional reserve banking, and fragility also increases when market panic occurs. During a financial crisis caused by a bubble from the real estate market in America, a bank run was about to ensue. A bank run is when everyone attempts to retrieve higher levels of money, like gold, because confidence in the lower layers of money is low. This financial crisis would have wiped out the Bank of England's gold reserves in its entirety due to their practice of fractional reserve banking. The Bank Restriction Act of 1797 suspended all convertibility of notes to gold, effectively blocking the people's rights to claim the gold that they were promised. This act was profound because it was a government's attempt to make the second layer of money stand alone as currency since the first layer was unavailable. This crisis also demonstrated the need for an ever-continuous expansion of a world reserve currency in order to keep the markets liquid during a financial crisis.